RP Sanjeev Goenka Group, growing legacies.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then. Independent investment advisor Vivek Mavani, Kalra of Target Investing, and Senthil Manikandan of Newberry Capital join me on the show. Thank you to all for joining me on the show. The stocks that we want to discuss on Hot Money is, first of all, we want to discuss Asian Paints. Asian Paints has corrected significantly from the highs that it was. A double impact of crude as well as rupee will impact numbers going ahead, but are now valuations much more worthwhile for Asian Paints. We'll discuss Bajaj Finance. Is it the time to start accumulating Bajaj Finance after a big 33% drop from the highs that it had? Oil marketing companies most of them are trading now sub-book. Is it time to start accumulating OMCs on the basis of financials, or would you avoid given the government intervention? And as far as the market is concerned, we ask our guests for one buy or a probable sell, which we leave it up to them, call to deal with in these market conditions. The first stock we want to talk about is Asian Paints. Obviously, it will get impacted the way crude is moving. It has a derivative of it. Titanium dioxide prices have gone up. You also have the rupee, which also makes some of the imports much more costlier for Asian Paints. But are now valuations trading at the day's high? But are valuations now in reasonable or pretty much decent spot is something that we're asking our guests. So, Samir, Asian Paints, it has corrected from the highs, not as much as the others. But are valuations now much more stable, reasonable, and at this level after this drop, would you recommend accumulating Asian Paints, or would you just avoid?
So I think we'll avoid it for now because we see a longer crude cycle going up, much more bullish. On that parameter, we will avoid any crude consumers indirectly or directly. Asian Paints, if I standalone, they have come up with new capacities and they are into capex zone as well. Now, if you see, I would like to see the next 2 quarters volume growth, which will come through, because then you have a higher base. And now, if they perform on that, then only the new capacity gets utilized. Till then, the numbers will be pressurized by the new capacity if that doesn't get utilized on a bigger sense. So I think I'll stay away for now.
Okay, you'll stay away from that. I'll get back to you. Senthil, what should one do with Asian Paints?
So I'll also stay away from this counter because if you go back to 2013, when we have faced the same macro situation with rupee depreciation and oil price increase, the margins were around 16%. So they were able to maintain around 16% when the rupee depreciated and the crude oil was going up. But now I think in the last 3 years with stable crude oil and rupee has been in the stable range, they are able to inch up the margins to around 19 to 20%. Okay. So now we have to face off whether the company is able to pass on the increase in raw material cost to the customers. So I think they have taken a price hike of around 3.3% in the last 1 quarter. I think this could help in maintaining the margins at around 19 to 20%. But going forward with rupee depreciation has been around 20% plus the crude oil is inching up. Like Samir mentioned, I think with winter kicking in, I think there is upside, further upside potential in the crude oil prices. So even though I think they are the market leaders in the decorative segment, 50% market share, plus being the market leaders and the brand power, they should be able to pass on the X, but how much they are able to pass on and how much they are able to take a hit on the P&L is the concern. So I could avoid at this point.
So if he is the market leader and he's facing pressure, will it be worse off for even the smaller listed companies in the paint segment?
Definitely, I think, because if you look at the cycle, I think most of them benefited in the 2014, post-2013 era. I think with Asian Paints having a huge distribution built up and 90% of their revenue comes from the decorative segment, I think if you look at the other players, I think there is a slightly different mix of revenue scheme, because if you look at Kansai, they are mostly into the industrials, coatings and automobile. So we can compare Asian Paints and Kansai, but I think a whole lot, I think the segment itself could take a hit on the margins.
Okay, so that's the trend that's coming in from Asian Paints. And Vivek, what should one do? Are valuations reasonable, or would you stay away?
Well, valuations certainly now look high, because let me dwell slightly into concept. valuation multiples are a function of sentiment in the short term, but in the longer term, it's about growth, return on capital, return on equity, and cash flows. So as far as Asian Paints is concerned, the multiples, suddenly because in the last 1 month, the sentiment in the markets overall has turned negative and for various reasons. So Asian Paints has also corrected, and I would not rule out a further correction, but I have a slight contrarian view compared to my co-panelists. I would be a buyer on declines as far as Asian Paints is concerned for 2 reasons. It's not the first time that Asian Paints is facing a scenario of a weak currency and higher oil prices. I mean, in the last 20 years, if you see, I mean, it's probably the 4th or the 5th time that we have this kind of a cycle playing out. And when you look at the performance of Asian Paints over longer durations, yes, quarter by quarter, there could be aberrations or a hit on margins because of the input price pressures, because of the currency pressures. But over a period of time, and when I say over a period of time, 1 or 2 quarters is generally what it takes for companies like Asian Paints or Berger or Nerolac to make price adjustments, which basically means increase prices, maintain their margins, and maintain their return on capital, return on equity. So over a 20-year period, if you were to look at, you don't see crude cycles, or you don't see cycles of rupee dollar weakness at all. I mean, they have had predictable range of margins, predictable range of return on capital and return on equity, and predictable range in terms of cash flow in relation to their size of operations, in terms of namely what we are referring to as top line. So from that point of view, in the short term, yes, the correction, it could correct in line with overall market sentiment, which itself is in a corrective mode. But from a longer term perspective, I would be a buyer on declines for a long term portfolio holding.
Okay, so that's the view that's coming in. Samir, is the concern that you share on all the paint company what you said, being Asian? Similar question to what...
So I share the
Which is the best place and worst place if someone wants to place a paint company?
I think Asian Paints will be the worst one because the new capex is at the higher cycle of the crude. So the raw material consumption will be higher, and the depreciation and other numbers will suppress the PAT unless they are really able to push through the utilization very drastically, which I have kind of a doubt on, because real estate is eventually the main consumer at the end of it. Second of all, I think Kansai Nerolac is one of the places where I like to be if I'm really interested in playing this off, because over there the capacity is into the system, and it's still additional capacity is at least a year ahead. So I think the numbers will be much better off, and the industrials helping them out will help the whole system for them.
Okay, so that's the view that's coming in on Asian Paints at this point of time. 2 of our guests will believe that it's time to stay away from Asian Paints. There could be more potential downside. Vivek's view is that, he also agrees that there could be more potential downside, but it's a buy on decline sort of strategy that he's talking about on Asian Paints. The other stock which has surprised the street with its fall, no doubt valuations were extremely stretched and now has fallen from levels in excess of almost hit 3,000 on the counter. It went below the 2,000 mark. So more than a 33% correction was something that we witnessed in a prime NBFC like Bajaj Finance. Is Bajaj Finance a good bet after a 33% correction, or is there more potential downside? Senthil, do you see 2,000 as a good opportunity to accumulate Bajaj Finance for maybe even a slightly longer term, or is there more potential for a downside now?
I think business-wise, we like the counter because if you look at other NBFCs, the major concern right now is on the liquidity side. But if you look at Bajaj Finance, is one of the, I think it's topmost on the ALM side, because there, if you look at the 1 year bucket, I think they have around 30% more assets coming on compared to their liabilities. So they are uniquely positioned, comfortably positioned with respect to liquidity concern. Okay. So with this concern, I think they will be able to gain market share from the other NBFCs. And coming on to the asset side also, I think they are quite diversified. Around 40% comes from the consumer segment, and even look at the HFCs and LAP portfolio around 10% on the asset book. So diversified asset book and also comfortable liquidity position will push the growth going forward. But we are expecting slightly tapered growth from here on. I think they have been doing around 40% kind of growth on the loan book side, but I think we're expecting around 30% kind of growth going forward. So with this tapering of growth, I think whatever the multiples that the counter enjoyed in the last 3-4 years, it has to be brought down. So even the recent correction, I think the stock is trading at around 7 times FY19 book value. I think still it's expensive. I think I'm expecting around another 15-20% correction to.
What's a reasonable multiple for Bajaj Finance?
So I could look at on a PEG ratio. So I'm expecting a price earnings growth of around 30% for this stock. So currently, if you look at the price to earnings multiple for the counter is around 50 times.
Okay.
So I could accumulate it at around 1.1 to 1.5 times kind of PEG multiple.
Okay, so that's the view that's coming in on Bajaj Finance. Vivek, Bajaj Finance is a good time to enter the counter now?
Oh yeah, sure. So I'll just quote Ben Graham on this. I think the short-term markets are a voting machine, and the long-term they're a weighing machine. So when we are talking of the voting machine in terms of NBFCs, the last 1 month clearly market has just turned adverse towards NBFCs and financials in general, including private banks also, barring a few exceptions. But in the longer term, what would play out is again growth, return on equity, cash flows, and so on and so forth. And when we look at what really got us into this situation of NBFCs being having a negative sentiment suddenly, we have basically three kinds of issues, and different NBFCs could be into one of the three buckets. One is rising interest rates, compressing their margins, tight liquidity conditions in the money markets. It probably will impact growth because of tightness on NIMs potentially. Number two, balance sheet issues is which is most spoken about, which is about asset liability mismatches, which most people may be facing. I mean, different NBFCs face it differently. Third being management and governance related issues. Now, every NBFC could be in one of the three. Bajaj Finance probably, as your visual highlighted, Mahindra Finance as well, don't really have any of these problems, neither the growth problem nor the asset liability misses, or the balance sheet problem nor the or even the management or balance sheet related problems. So while everybody in the sector will be grappling with one of the three or multiple of these issues, the better ones will be able to focus on growth and take share aggressively from others that the space had gotten crowded, number one. Number two, as Senthil pointed out, Bajaj Finance is most favorable in terms of their cash flows, in terms of asset liability mismatch, so which actually help or will potentially enable it to accelerate the growth going forward, while most of the competition will be constrained to be growing as fast because they probably need to raise a lot more capital in the short term, both by equity and debt, and equity may be difficult to come by. Debt may come at higher rates, which may probably put some pressure on their net interest margins. So in that sense, from the valuation point of view, although Bajaj Finance at 5 times book value for 2020 estimated book value, maybe about 6.5 times current year price to book may look expensive, but over a period of time, if the 28-30% growth were to sustain, then probably again I would again be a buyer on declines, with a rider that yes, in the short term the sector is has got a negative sentiment, so the price correction could continue after a very stellar rally that we had. Let's also not forget that the journey from 1,000 to 3,000 in case of Bajaj Finance was practically without any correction in the interim. So if there is a correction, I think I would be a buyer on declines as well in Bajaj Finance.
Vivek, in terms of the notification that came in from the RBI on Friday, in terms of warning NBFCs against ALM mismatch, is that not a concern for the whole sector? And if the whole sector comes down, Bajaj Finance will also be. Who's the worst placed and who's the best placed?
Well, I have not looked at all the NBFCs, but I would assume the very fact that RBI had felt the need and the compulsion to come out with such a notification and a circular or some sort of a guidance for the sector in terms of how they should be conducting themselves going forward, which certainly means that RBI knows a lot more about the performance and the business of these NBFCs than you and I do. Probably RBI knows a lot more than what NBFCs, because most NBFCs and banks, I mean also including private banks in this category, because they also tend to have that problem, is that probably RBI knows a lot more than what even the disclosures these companies seem to be making, because most NBFCs have come out with clarifications. No, hey, we are not affected. We don't have asset liability mismatch. But hey, but here it's the RBI which is giving those guidances in terms of how they should be conducting themselves. So I would assume that there is a problem which is for the entire sector, except where Bajaj Finance, the business is very clear. I mean, their business is, much of the business is short-term loans, while their capital is long-term in nature, unlike lot other housing finance companies or some other NBFCs, whose lending itself is long-term, but their entire balance sheet is not funded by long-term liabilities.
Okay.
So I don't know, I wouldn't be able to give specific names, but at least for Bajaj Finance and Mahindra Finance, I'm certain that they don't have this problem.
Okay, Samir, your view on the NBFC space, is there more pain, and on Bajaj Finance as such?
So I think NBFC pain hasn't even started from what we think.
Okay.
Because of the rate hikes are still only 2 rate hikes of 25 bips. Whereas your crude oil and the inflation in rupees will kick in Feb and March. So I think over there the rate hikes are being postponed because I think there are adjustments in the ALM side, which RBI wants the NBFCs to do it. Bajaj, out of the whole lot, we already own at a very low levels, at a very old stock. But still we won't buy it at right now, because if the whole sector faces an issue, Bajaj will not be left alone. It might not fall as much as others, but the fall will come for them as well. Because if the liquidity situation tightens for everyone, and which has tightened, and I think then Bajaj will also face an issue because they can't keep on doing QIPs for endless number. There's a dilution call over there which they have to take. So I think I rather wait and watch for 6 months to play out.
Okay, so that's the view that's coming in on Bajaj Finance. Two of our guests believe that it should be accumulated on declines. Samir does believe that the pain in NBFC is something that can probably start even now. The next sector is the oil marketing companies, trading at cheaper valuations, and then suddenly the big move from Arun Jaitley sent all the stocks crashing down by anywhere between 30 to 40% in trade. What's the view on oil marketing companies? Are valuations now attractive, or will you avoid given the government intervention? We'll ask our guest. Vivek, would you touch any of the oil marketing companies?
Well, as much as we are tempted to, after a 40% decline in the last 1 week itself, and actually if we take from the 52-week highs, all of them have probably corrected more than 50%. But it is certainly now a no-go area. And the reason is not so much about that 1 rupee price absorption which oil marketing companies have been asked to do. In aggregate, the sector would take probably 7 to 8,000 crore estimated hit on their profits across 4 companies or 5 companies, whether we don't know whether GAIL and ONGC will also be made to absorb some part of the subsidy burdens. There's still not much of clarity, but I'm assuming they will also be. So I'm saying 5 companies, otherwise 3 companies. It is the direction which has spooked market participants, not as much about a hit of 7,000, 8,000 crores. I mean, certainly these companies can bear that burden of subsidy indirectly. And what spooks us all, as much as I find the valuation and the growth attractive, growth versus valuation equation attractive, is that it is recently we have had several instances of government diktat coming suddenly, which just impacts the growth and profitability of these PSUs. So in a way, even in stable businesses, their earnings growth just become just too uncertain. There's just too much of a cloud of uncertainty. I mean, they did it about a little more than a month back as far as Bharat Electronics was concerned, basically the defense orders where there was a margin cap and then it came with riders. Although the impact is going to be felt over a very long term, it basically speaks of direction. It speaks of the philosophy the government seems to be having, that when in trouble, basically hit the PSUs for funds. And that doesn't seem to be going well. I'll just add one more thing. Where the market has corrected sharply in the last 6 to 8 weeks, there are enough other stocks that have far more predictable earnings, far more predictable business dynamics about margins, growth and return on capital, return on equity. Then why should one be adventuring into the oil marketing companies or PSUs as a whole? Why not look at a lot more other companies, both in the large cap space, which are part of the Sensex and Nifty, probably it's much, I mean, we are much more better off in those companies and oil marketing companies.
Okay, Senthil, would you venture into oil marketing companies or stay away?
No, it's avoid for now. Because if you look at the business, so far they have been talking about the decontrolled kind of business. Now it officially moved into a regulated kind of business. So I think the market was expecting this kind of move, because in the last year to date, I think the entire segment was underperforming the broader market. But what kind of spooked the market was in the last 1 week is with respect to the government's move on the steep decline in the marketing margin. So I think with this, I think the most among the three PSUs, OMCs, I think HPCL is the most adversely impacted, and the expectation is that their marketing margin will go into the negative kind of range. And compare, so with this and sentimentally being negative and things like that, I think it's a avoid for now.
Okay, would you avoid this, Samir, or is it a good time to start accumulating?
So we've been avoiding it for a while now, because again the crude prices and everything gets into factor. The plus, if you see the furthermore negative, that next year your general elections are kicking in, and if the crude hits 95 or 100, then it's going to supersede and accelerate. The other part is next year they have to put the capex for BS6 to hit in 2020. So the cash flow any which way was outgoing. Now intervening in the fuel prices, you might not call it regulation kicking back, but in the election sense, you're taking out the cash again out of their books. So any kind of a capex during that time, and when you're suppressing their cash flow, I think will create a huge downside for them.
Okay, so I think it's a consensus, negative view or an avoid view on the oil marketing companies. And the final stock that we want to talk about, it could be an either buy or it could be a short. One stock idea for in such turbulent market. So Samir, I'll start with you.
Yeah. So we're just avoiding and liquidating our positions in this market. We've just recently bought Yes Bank on the low valuation around 190, 195, and that is also on a short-term trade kind of call right now. We'll review it once the whole clarification on the management comes in. Business-wise, it's still strong, and if in next 2 quarters we don't see any harm on the NPA side or the asset quality side, I think that's a good place to be right now.
Okay, Yes Bank is something that Samir likes. What about you, Senthil?
So we like Thomas Cook in this space.
Okay.
Because now I think the management is going for a restructuring. So with this restructuring, they will be spinning off the Quiz Corp. So
Okay.
all the shareholders of Thomas Cook will be getting the Quiz Corp. So I think effectively the holding company discount goes off. Second point is they are also undertaking their consolidation among the travel business and forex business. So now they have last 3-4 years they have acquired couple of inbound businesses and also the destination management business. So I think with restructuring of Quiz Corp and consolidation among the existing travel business and forex business, I think they'll be able to do a bit of around 200 crores. If you look at ex-Quiz Corp, if you look at the value of the legacy travel and forex, it's around 1,200 crores. So effectively, you're getting a business that is free cash flow generating at a free cash flow yield of around 10 to 12%. And in this macro environment with interest rates inching up, I think going in for businesses that have a solid balance sheet and free cash flow generating is like a good play. And another thing is there on the risk side, what we are factoring is that their Sterling Gold days, which they've acquired 4 years back, hasn't performed so far. So they have spent close to around 1,000 crores so far. But on the operating margin side, Sterling Gold days is yet to show profit.
Okay.
So one risk factor should be the non-performance of Sterling Gold days.
Okay, what about you, Vivek? One stock that either could be short, could be buy.
Well, so I'm going to give 2 buy recommendations itself, not really on the short side. If I have to short, I'll probably short the Nifty or Bank Nifty itself. But on the stock side, go long. So I'm going to take the liberty of 2 stocks, although you asked for 1. So one in large cap, of positive on Hero MotoCorp. We discussed it last week as well. So in terms of valuations, it's at multi-year lows in terms of valuation multiples, while the consistent growth story in terms of volumes continues. So over the 3 to 5 year period, confident of delivering 10 to 12% volume growth, translating into 15 to 17% earnings growth, which I'm comfortable about. It trades at about 13-14 times current year earnings, which is in a balance sheet which is almost 70% cash and cash equivalents, return on capital, return on equity in excess of 50% on a sustained basis. The other stock, mid cap, called KEI Industries, which is a full range of cable, the power cables, basically high tension, low tension, right up to house wires. On the transmission side, they also make extra high voltage cables. So basically entire range of cables, including control cables, rubber cables, cables that go into marine and refining segment, all of it. Timely capacity expansion, number one, steady margins, consistency of business, will deliver roughly about 20% earnings growth over the next 3 to 4 years. On a steady debt, margins also in the range of about 10 to 11%, but a better revenue mix with higher component of consumer side of the business, which is house wires, and EPC projects in the power, which also give them slightly higher margins, will over a period of time maybe move the needle in terms of margin over a slightly higher over the 3 to 4 year period. Post this correction, it trades at just about 6-7 times EV by EBITDA, trades at about 12 times earnings on a forward basis, which is quite cheap for a company that delivers 25% return on equity and will deliver 20% growth rate without increasing the debt. So at a steady debt from the and a very good cash generation in excess of 250 crores per year, which and the capex is just going to be about 100 crores per year over the next 3 to 4 years. So from a valuation point of view, I find comfort. In a correction, this also could continue to fall. I mean, it could continue to correct, let me put it this way. But I would be a buyer on decline for this company.
Okay, so those are the counters that our guests have spoken about at this point of time. So Samir spoke about, Senthil spoke about Thomas Cook. Yes Bank is something that Samir spoke about, and Hero MotoCorp as well as KEI Industries is something that Vivek spoke about. But with that, it's a wrap on today's Hot Money. Samir, Senthil and Vivek, thank you so much for coming to the studio for the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.